All right, let's dive in. What we're going to do here is build a practical toolkit for making better decisions, drawing on some of the smartest thinking in the world of investing. Think of this as your personal masterclass on the very architecture of human misjudgment. The core problem we're really trying to solve here is this huge gap between simply knowing a fact and truly understanding it. I mean, anyone can repeat a talking point like a parrot, right? But a real master can take that concept and actually apply it. And that's the gap we're going to close today. There's this great idea called Chauffeur Knowledge from the physicist Max Planck. It describes someone who can repeat a speech word for word, but underneath, there's no real comprehension. These mental models we're about to cover, they are the absolute antidote to that. They're the engine that drives real understanding. So let's get started with the first 5. First up, incentive-caused bias. The rule here is incredibly simple, but it is so profound. People do what they are paid to do. Period. So instead of just parroting a CEO's grand vision, you have to dig into their bonus structure. Because if those incentives don't line up with the long-term health of the company, you're staring at a massive source of operational risk. That's when things inside the company start to break because everyone's just chasing the wrong numbers. So how do you actually put this to work? Well, it's like a 3-step diagnostic. First, you get your hands on the company's proxy statement and you find that executive bonus plan. What exactly are they getting paid for? Second, you have to ask the most important question. Does hitting these targets actually make the company better in the long run? And third, you have to get a little skeptical. Are these incentives pushing management to pump up this quarter's results, even if it means sacrificing the company's future? Next up, we have a really personal one, the liking or loving tendency. It's just our natural inclination to overlook the flaws in people and things we admire. We love the product, we think the CEO is brilliant, so we just kind of ignore the shaky balance sheet. This is the mental trap that turns analysis into a fan club. And if you let it run wild, it directly fuels concentration risk because you end up putting way too much money into your favorite companies. The way to fight this is with a really strict 3-step protocol. Step 1, you have to be ruthless. Make a list of every single objective weakness and every competitive threat. No excuses. Step 2, run a little thought experiment. If this company was called Boring Corp and run by some random person, would you still invest based on the numbers alone? And finally, step 3, let your spreadsheet, not your feelings, decide how big the position should be. And of course, the flip side of loving something is the disliking or hating tendency, where we completely ignore the good qualities and things we don't like. This mental model is what forces you to look for value in places no one else wants to touch. It stops you from just lazily dismissing an entire industry. And the risk here is huge. It's opportunity cost. Your personal feelings could be blinding you to a fantastic investment that the market is just punishing unfairly. Here's a really powerful contrarian exercise for you. Step 1, pick an industry you just instinctively can't stand. Step 2, force yourself to become its biggest champion. Seriously, build the strongest, most convincing argument you can for why its best company is a great investment. And now, step 3, with that new perspective, look at the valuation. Has the market sold this thing off just because of emotions, creating a huge opening for a rational investor like you? Confirmation bias. Now this one is really sneaky because it feels like you're doing diligent research. But what you're really doing is just looking for things that prove you were right all along. The only way to stop just parroting your own first idea is to actively go looking for evidence that you're totally wrong. This bias is a direct line to model risk because it makes sure that the assumptions in your financial models never get a real challenge. Beating this takes real discipline. Here's the process. First, boil down your entire investment idea into one single clear sentence. Second, set a timer for 1 hour. And during that hour, you are only allowed to research arguments against your idea. And third, you make the attack official. You find a colleague to act as a red team whose only job is to poke holes in your argument. That is how you build an investment case that's actually tough. Okay, next we have the availability heuristic. Think of it like this. Your brain is a search engine, but it ranks results based on how dramatic or recent they are, not how statistically likely they are. A scary headline always feels more real and more important than a boring old data table. Understanding this forces you to trust the data over the drama. And this is a huge driver of market timing risk because it causes people to panic sell based on whatever scary story is on the news today.
This airline case study is just the perfect real-world example. So, step one, a plane crash happens and it's all over the news, right? It's a vivid, scary event. Step two, the immediate emotional reaction is to sell airline stocks because that image of disaster is now highly available in your mind. That's the bias kicking in. But step three is where discipline comes in. You ignore the anecdote, you look at the long-term safety data, and you realize that the market's emotional sell-off is probably a massive overreaction and maybe even an opportunity. So we've built a really solid foundation with those first 5. But the key thing to remember is that these models don't work in isolation. They all weave together to form this integrated latticework of rational thought. So let's add the next 5 models and see how it all connects. Okay, now for the reciprocation tendency. We are just hardwired as human beings to want to repay favors. And in normal life, that's a good thing. It holds society together. But in finance, it can be pure poison. This is the mental model that stops you from just parroting a broker's hot tip and instead forces you to ask, okay, what do they want in return for this? When this bias goes unchecked, it can create serious governance risk, where big decisions get made based on who owes who a favor. So the next time one of those free research reports lands in your inbox, you run this simple defense protocol. Step 1, recognize the report for what it is. It's a gift. Step 2, immediately question the motive. What does the person giving the gift want in return? Almost always, it's your trading commissions. And step 3, because you know there's an inherent bias, you are now obligated to go find independent third-party research to double-check every single claim they make. Next up is social proof, which you probably know better as the herd instinct. It's that dangerous little voice in your head that assumes, well, if everybody is buying this stock, it must be a good idea. This mental model is your firewall against that kind of thinking. It stops you from just parroting the crowd and forces you to do your own work. Because when the entire herd runs in one direction, that's how bubbles get inflated, and you create systematic risk for the whole market. The practical way to use this is as a disciplined defense against hype. When a stock gets really hot, you run this 4-step play. 1, you see the stock soaring, you see the headlines. 2, you consciously and deliberately ignore all of it. 3, you build a valuation model from a completely blank spreadsheet, as if you've never even heard of the company. And 4, your final decision is based only on your own work. That is how you stay independent when the pressure to join the crowd is highest. Authority misinfluence is our tendency to just outsource our thinking to so-called experts. This mental model sets a very firm rule. You never, ever blindly copy a famous investor. That is not a smart shortcut. It's abandoning your duty to do the work, and it leads directly to due diligence failure risk, because you're just assuming that the guru has already done all the hard thinking for you. So when a big-name investor makes a pick, you should treat it with professional respect. Step 1, you take note of their position. Step 2, you frame it correctly in your mind. This is one interesting piece of data. It is not a conclusion. And step 3, you do all your own work, but with a twist. You're specifically trying to find what they might have missed. You respect their idea enough to try and prove it wrong. Now let's talk about the scarcity principle. When something is rare or seems to be in limited supply, our desire for it just goes through the roof. This is the psychological engine behind the fear of missing out, or FOMO. In the financial world, you see this with hot IPOs and bidding wars, where you get this feeling that you have to win the deal no matter the cost. And that, of course, directly inflates what you're willing to pay, creating massive valuation risk. So here's the protocol for when you're in a competitive deal. 1, you're in a bidding war. 2, you have to acknowledge that the scarcity mindset is kicking in, that emotional, primal urge to just win. And 3, here's the crucial discipline. You set a firm walkaway price based on sober, fundamental analysis before the bidding even starts. And then you have to have the courage to walk away if the price goes past it. Sometimes the best investment you can make is the one you don't. Our final model for today is anchoring bias. That very first number you hear, whether it's an asking price for a company or just its 52-week high, it becomes this powerful psychological anchor that all of your other judgments get tied to. This is so important for valuation. Just like the scarcity principle, this bias is a direct path to valuation risk, because your idea of a fair price gets polluted by a starting number that's often totally irrelevant. Let's lock this one in with a final quick case study. Imagine a startup's pitch deck says a competitor just got bought for $500 million. Boom, that's the anchor. Your brain is now biased. It instinctively wants to value this company relative to that huge number. The correct, disciplined process is to mentally cut the rope to that anchor. You ignore it. You build your valuation model from scratch based only on this company's fundamentals, and you arrive at your own number, totally free from their influence. And there we have it, the first 10 tools to put in your mental toolkit. This is the framework you need to move beyond just repeating things to having a deep, functional understanding. But the real work, it starts right now by turning this analysis back on yourself. So I'll leave you with a question that I think requires a really honest answer. When you look at your own decisions, your own portfolio, which one of these biases is your biggest blind spot?